do have the governor ready in the press conference for this monetary policy. I think we can cut across.
Hello and welcome to the first policy of 24-25. Today with us we have Governor Shri Shaktikanta, Deputy Governors Dr. M.D. Patra, Shri M. Rajeshwar Rao, Shri T. Ravi Shankar, Shri Swaminathan J, and two Executive Directors, Dr. O.P. Mal and Dr. Rajiv Ranjan. So as is customary, I would request Governor to make some opening remarks and then we'll go for the Q&A.
Good morning. Namaskar. I guess I will not be off the mark if I say that the policy overall is on expected lines. So it demonstrates that I think the Reserve Bank, the market participants, the market players, and perhaps the media and analysts and all, every stakeholder, I think the thinking is at the moment well aligned so far as the monetary policy is concerned. But having said that, I just want to make 5 observations. First, inflation is moderating and the GDP growth is robust. Number 2, the Monetary Policy Committee remains focused on aligning inflation to the target on a durable basis. We derive satisfaction from the progress made under disinflation, but the task is not yet finished. Number 3, the financial sector continues to be stable. Number 4, external sector also continues to be resilient. Number 5, as we move towards RBI at 100, the Reserve Bank will continue to focus on preserving financial stability and promoting a financial sector and a payment system that is robust, resilient, and future ready. Thank you.
Thank you, sir, for those opening remarks. I will, before inviting all of you, I'll request you to please restrict to 1 question per person, and if time permits, we will go for another one. I followed the names. I'll start with Mr. Ankur Mishra from ET Now.
Good afternoon, Governor. Thank you, Yogesh sir. My question is that you have mentioned that the elephant has reached in a durable basis. Is it still outside the room or it has already reached forest? Why I'm asking, because in your projections you have said that in Q3 and Q4 there is going to be slight uptick in inflation. So what is your assessment?
The elephant moves at a slow pace. So therefore, the last mile of disinflation is always challenging and sticky. And as I have very clearly stated, we would like, inflation to align with the target on a durable basis. So that is the, that is what we are looking for.
Thank you.
Thank you, sir. I'll move on to Mr. Mayur Shetty from the Times of India.
Governor, in your speech you specifically mentioned the need to build up foreign exchange reserves. So, this is something that RBI has been doing and the rupee has been stable. So is it that the stability has moved up in the list of priorities for RBI?
No, it has always been the priority of the Reserve Bank to ensure stability of the Indian rupee. And I have myself stated about it on a number of occasions. My colleagues have also talked about it on a number of occasions. So far as building up of reserves is concerned, I think consciously we have, over the last 4-5 years, we have been building up reserves whenever, as the market moves, depending on the prevailing market situation. So, and that endeavor continues because it acts as a buffer against future risks, especially in situation when the cycle turns and if there are significant outward flows of dollars. So I have said it earlier also, so it is by way of a buffer that we are building up reserves. It adds, and this is very important, this whole approach adds to the strength of the national balance sheet.
Thank you, sir. I'll move on to Mr. Anup Roy from Bloomberg.
Thank you, sir. Sir, just trying to understand a little bit about your thinking on the heat wave warnings. You have not changed your inflation forecast that much, but will you be watching out for the heat wave warnings first, and what is the impact that's going to be before taking a call? Or you have, seen and, decided that it is not that materially important?
No, there is a statement coming out from the IMD that the temperatures, I have not said heat wave, I have said the high temperatures. The IMD has stated that the high temperatures, and perhaps they have used a different word. They have not used the word heat wave, but the temperatures are going off normal in the months of April, May and June. So we have to really watch what impact it has on, especially on food crops, and in that I have mentioned specifically about certain key vegetables. Now, so far as wheat crop is concerned, our information is that by and large the harvest is over. In central part of India, it's fully over, excepting maybe a few areas, and even in other places also. By and large, the wheat harvest is over. So therefore, the wheat crop, availability will not be affected as much as it did some 2 years ago when there were heat wave conditions starting March. So therefore, wheat, there is not so much worry, but there is not so much concern. But vegetable prices have to be watched, and any other impact that heat wave conditions that may produce.
Thank you, sir. I'll move on to Ms. Ritu Singh from CNBC-TV18.
Governor, just a comment on, thank you for the question. On the exchange-traded currency derivative rules, it's very clear that RBI stance has not changed. Yet the market, of course, has grown to almost $5 billion of notional turnover on a daily basis. Now that this deadline has been extended, but still the fact remains that you're asking for the underlying to be there when these trades are undertaken. We just wanted to understand, was there a concern that RBI had about, risks, whether it comes to the financial or the currency, because of which this deadline was put in the first place for a rule that has stayed in place for now 10 years?
Okay. I guess there could be some more questions on this issue. If there are any, you could just mention so that we take it all together and give a common reply. I mean, if she has already mentioned certain points other than that, but related to this matter.
Exactly.
If you have any question, you can just put it so that we take it all together.
Exactly. The question is that yesterday you extended the deadline after 5:30, after the trading hours. The market has died by that time, but you still have extended the deadline. What is the reason for extending the deadline by 1 month? Is there a scope to review your decision? That is the question.
Okay. Yeah.
So the
But
volume.
please remember that you are exhausting your opportunity to ask a question.
You said you're taking all these together.
So please keep that in mind.
So no, just wanted to understand.
Unless you are asking something fundamentally different.
No.
I wouldn't,
are you okay with the volumes completely dying down in this market? And globally, the underlying is not a requirement in most markets. So why is that rule being made especially for India, and why have we had that position for the last so many years?
Okay, I think I take it that these are the questions. So may I request DG Michael Patra to reply to that question, and I will, if necessary, I will supplement.
Governor. Yeah. So let me just quickly review the whole thing so that everything is in perspective. Please also read our press release of yesterday. We typically issue after market hours, so it is in keeping with RBI's style. The RBI's policy on foreign exchange risk management has remained consistent over the last few years, and there is no change in the policy approach. That is what I want to emphasize at the outset. So in 2008, when exchange-traded currency derivatives were introduced for the first time, they were introduced under the aegis of the Foreign Exchange Management Act and the regulations of FEMA clearly stated that ETCDs are for hedging only. And when you state that, it implies that you must have an underlying exposure. In 2014, the RBI, to promote the ease of doing business, provided a relaxation in the sense that while you must have underlying exposure, up to 10 million of that exposure, you need not produce documentary of it. Since then, over the next few years, that limit was raised to 100 million just to provide an incentive for market turnover and to expand the size of the market. But the moot point is that it is only for hedging and underlying exposure is a mandatory requirement. The January 5, 2024 circular was in pursuance of a commitment made in the monetary policy statement of December 2023, in which we said that there are all these stipulations all over the place. We will bring it together into a master direction. And the January 24 circular was a master direction. It just reiterated what has been there since 2014. So there was no change in it. Now, some market participants have been misusing this to understand that a relaxation in evidence is tantamount to no underlying, which is not the case, and that is a violation of the law. I don't know if Governor wants to add.
No, just I want to supplement by summarizing what the Deputy Governor said, is that there is no change pursuant to yesterday's circular or even earlier. There has been no change in RBI's policy. This policy of this need to have an underlying has always been a part of RBI's policy for last so many years. So there was no change. And this is something which every market player knew. You cannot say that this is something new. If you read the circulars very carefully, it has been always there. So therefore, if somebody says it is new, it is not correct. I would like them to refer to the circulars. That is the purpose for which we issued the circular yesterday, just to, because there was some kind of a narrative was building up in certain quarters, we wanted to make it very clear that there is nothing new. This has been the requirement all along. Market players knew about it. It is a part of FEMA regulation, the need for an underlying. And all that we have done is to sort of issue this circular, and there was also a question, or maybe there is a possible question, what was the need for extension? Let me change that and say that we received feedback and requests from several market participants that they need more time. The earlier circular was issued in, the master direction was issued in January. And let me also say why the master direction was issued. In the December monetary policy, statement, the regulatory and the developmental part of the monetary policy statement, we had very clearly said that master direction was issued in January, first week of January, and it was said there very clearly it takes effect from 5th of April. So everything was crystal clear. But because of requests which we have received, and because of the kind of narrative which was being built up as if it's something new, what we did is to just reiterate the earlier position and say that it is nothing new. It has been always there. And number two, because of requests which we received from several market players that they need more time, we extended the time for the implementation of that January circular. So instead of April 5th, we have now made it 3rd of May. No, this has been a consistent position. It's a legal requirement under as per FEMA regulations. So where is the question of a review of that? It's been there for last so many years.
Thank you, sir. Thank you, sirs. I'll move on to Mr. Laltendu Mishra from the Hindu.
Good afternoon, Governor. What is fueling the food prices inflation, and whether it is a new normal? And second question is, in an election year, what are the factors the RBI is watching out for?
We have given our projections for inflation and growth for 24-25 up to the fourth quarter of the year. Inflation, we have said it will be 4.5% for the whole year. Growth, we have said it will be 7% for the whole year. And when 7% growth happens for the current year, it will be the fourth successive year of 7% or higher growth. Beyond that, on elections, I would not naturally like to say anything. And with regard to food inflation, I think let Dr. Michael Patra reply to that.
So food inflation has been highly volatile. In fact, in February it was 7.8%. And the indications are that in view of adverse climate events recurring, it will remain high. The actors keep shifting. At some stage it was cereals, then it went to vegetables, and currently it is the proteins, eggs, meat and fish, while there is still some firmness in rice prices. So these are short duration spikes, but since they occur in multiple occasions, they give a persistent character. So what we are worried about is that there should not be any spillovers to the rest of CPI. So we watch very closely.
And before we go to the next question, I mentioned about this above normal temperature. I have the IMD release with me. It says that during 2024 hot weather season, it talks about hot weather season, April to June, above normal maximum temperatures are likely over most parts of the country. So it talks about hot weather season, it talks about above normal maximum temperatures. Yeah. Next question.
Yeah. Thank you, sirs. I'll move on to Mr. Govardhan Rangan from Economic Times.
Thank you, sir. So thanks for the no surprises policy to start with. So one of the things that's happening is that the real rates, what they say, it's at almost double that of what an RBI itself had suggested in 21-22, almost 200 basis points. So one of the MPC members in the last minutes had also indicated that probably we may be sacrificing growth if you're not reducing the interest. Is it this high rates almost double suggested by the RBI research itself? Is it kind of a sacrificing growth at this point of time? Thank you.
I think DG can reply to that.
No, you should assess the level of the real rate in terms of the distance at which inflation is from the target. Even going 12 months forward, inflation is not at target. So that is our primary objective, that we must align inflation with the target. Until then, the real rates are not so high as you say.
Real rates do not matter till it reaches 4%. Is that what?
No, they matter, but we need to see the alignment of inflation with the target. That is the primary objective of monetary policy.
You see, under the law, the primary objective, as he has rightly pointed out, is price stability, inflation targeting. It is an inflation targeting framework. And talking about the real rate, that the earlier study by the RBI was done about 3 years ago or 4 years ago, 3 years ago, I think. 21-22. So that is about, about 3 years ago it was done. Much has happened since then. Our potential growth also appears to have gone up. In fact, when going by the NSO's forecast of 7.6% growth for the year 23-25, the average for the 3 years, that is 21-22, 22-23 and 23-24, the average will work out to 8%. So when your average growth over a 3-year period is 8%, naturally the potential growth appears to have gone up. We will undertake a study after the final GDP numbers for the current for the year 23-24. It is released end of May. After it is released, we will again undertake a study to assess this potential growth and the real rate, and maybe thereafter we can sort of provide you some additional information. So therefore the potential growth and the real rate have to be seen in, the real rate has to be seen in that context. I'm not reaching any conclusion, but I'm just saying that the real rate has to be looked in that from that perspective. But essentially, as rightly pointed out by the Deputy Governor, it is the level of inflation going forward, 1 year ahead, where the inflation is likely to be. That is what really guides us in our journey of attaining price stability.
Thank you, sir. I'll move on to Mr. Dinesh Unnikrishnan from Money Control.
Thank you, Yogeshji. I just wanted to know what is your view on the electoral bonds data that is published by the Election Commission of India following the Supreme Court directive, where companies have bought electoral bonds many times more than their net worth and profit. And also there are quite a few cases where companies which are even in losses, they have bought quite a few, about 600 crores worth electoral bonds. That is that. Have you looked at this data? Is there a possibility that RBI, looking at that, these companies probably would have been used by others as a channel for funding?
No, on electoral bonds, we have no comments. It's a Supreme Court judgment which has to be complied with, and which has been, in pursuance of the Supreme Court judgment. I think the bank involved, the State Bank, has taken the required action. So we have no comments on the Supreme Court judgment or on the issue of electoral bonds. And with regard to the issues you are pointing it out, that the net worth vis-a-vis how much they have contributed, these are issues which are not in the domain of the Reserve Bank.
Thank you, sir. I'll move on to Mr. Vishwanath Nair from NDTV Profit.
Thank you, sir. Governor, you spoke about the real rates in detail, but the bottom line is you're not seeing 4% in FY25, at least according to your projections at this point in time. There was hope that to cut rates in June, then the RBI might follow. Are we looking at any financial year or not? That's my primary question.
With regard to the rate cut this year, I cannot give you a forward guidance. In fact, countries which give dot plots also, the dot plots keep changing from meeting to meeting. So with regard to rate cut or whatever rate action, let me not say rate cut, but whatever rate action, it is linked to the evolving path of inflation. So on that, I cannot give you any forward guidance. And the other point which you mentioned about expectation linked to US rate cut, I think, as I have said on number of occasions earlier, our monetary policy is primarily guided and determined by our domestic situations. So we do not just follow the footsteps of the US Fed. In fact, if you just recall in the past several months or past few years in particular, I can talk about. We did our rate cuts, our rate cut which we did in 2019, or the beginning of the rate increase which we did in 2022. They actually preceded US Fed action. So therefore, our policy is governed and determined primarily by domestic circumstances.
Thank you, sir. I'll move on to Mr. Anand Adhikari from Business Today.
I think I said very clearly that we would like the elephant to return to the forest and stay there on a durable basis. And I reiterated by saying that we would like inflation to align with the target on a durable basis. So I think that needs no further elaboration. And that's for you to judge.
I'll move on to Mr. Shayan Ghosh from the Mint. So that's it.
Good afternoon, Governor. I wanted to ask, the Prime Minister on a Monday spoke of RBI's priority of growth. He, of course, then went on to add trust and stability. Does the government now want RBI to prioritize growth over inflation? Is that the reading?
I think you have answered the question. The Prime Minister talked about growth. The Prime Minister also talked about stability and trust. So therefore, my understanding is that what the Prime Minister said is in line with what is provided in the RBI Act with regard to inflation targeting.
Sorry, if I may add, sir, he led with growth, I thought.
Sorry?
He led with growth and then went on to add, so I thought.
Well, I mean, you can make any nuance, ask a nuanced question. Yeah, and he also used the word balance. If you recall, he also talked about balance.
Thank you, sir. I'll move on to Swati Bhatt from Reuters.
Thank you, Yogesh sir. So I had a very small question. Do you think the moderate falling core inflation is indicative of weak consumer demand? Is that something that is a concern at your end? And you've already answered the question on forex reserves earlier. Just a side note. So there is a cost to building reserves. Are you considering that cost as well, and how are you looking at that? And are you looking to continue building gold reserves? Thank you.
We are building up gold reserves. The data, is released from time to time. We are building gold reserves. You can compare, year after year, what is the gold reserve that the Reserve Bank is holding. So that's a part of our, that's a part of our reserve deployment. And what was the other question? Sorry? No, all aspects are obviously, all aspects are assessed. All aspects while building up the reserves are assessed, and then we take a decision.
Thank you, sir.
No, demand, you said consumption, you say weaker consumption. I think in the monetary policy I have said you have asked 3-4 questions, including the, the derivative, this thing, the exchange. Now the point is, what was that you said? So because you're asking so many questions, I'm getting mixed up. No, I think in the policy statement I have said very clearly that urban consumption remains strong and rural consumption is, has recovered and is gaining. So it's there in the policy statement.
I'll move on to Mr. Manojit Saha from the Business Standard. That's it.
Thank you.
He asked a question.
No, that was on currency derivatives.
Happy to skip.
Yeah.
The growth projection for FY25, you have kept it at 7%. And at the same time, you have earlier said FY24 could be closer to 8%. What will slow down growth in the current financial year? As you also said, the average growth was closer to 8% in the last 3 years, but this year you are projecting 7%. So what will slow down growth in the current financial year from the 8%?
The MPR has been released today. I think MPR has been released or will be released today. The monetary policy report should be getting uploaded now. It is already uploaded, yeah. So the MPR is already uploaded, so you can have a look at it. So maybe Dr. Michael Patra can further amplify.
The 8% will provide a base effect onto 24. The momentum is very strong. It's still as strong as it is in 23-24. Because it's a year-on-year growth rate. Not an
effect essentially you're saying.
Yeah.
Thank you, sirs. I'll move on to this side. I'll invite Mr. Ashish Agishe from PTI.
Thank you so much, sir. Sir, you in the end of your speech, you mentioned about the goal being in sight on inflation. You also gave us the target for FY25, your expectations for FY25. So, if 4% is the goal, like what sort of path do you see on inflation going ahead?
I think we have given.
See the target in sight.
Yeah, but we have given the quarterly projections also, no? For the next year, we have given the quarterly projections. I think Q2 it comes to 3.8%, but thereafter again it goes up. And there are so many uncertainties between now and each of these quarters. So we will be watchful and of the current prevailing inflation as well as watchful of what the outlook appears, how the outlook appears. So based on that, we will take a decision.
Thank you, sir. I'll move on to Mr. Piyush Shukla from the Financial Express.
Good afternoon, Governor, DGs and Yogesh ji. So very quickly, just you have allowed SFBs to deal in rupee interest rate derivative products today. There is also an ask that they want to shed their small finance tag because people feel a bit hesitant towards banking with such names. Apart from that, there are certain regulatory relaxations also being sought on PSL CRAR. So what is your view in this regard, sir? And separately, SRO framework to come out. Are you on board with them having dual mechanism? You had said in your circular that there needs to be a consensus on the membership criteria and
No, thank you for moving to the part B of the MPC resolution, because there are 7 other announcements which have been made, each of them very important. And on the first part about the SFB thing, I will request Deputy Governor Rajeshwar Rao to reply. And on the FinTech SRO, I would request Deputy Governor Ravi Shankar to reply.
Thank you, Piyush, for that question. See, SFBs actually have been conceptualized as a differentiated bank with a specific objective. And the tag of having an SFB after the name is a key part of that differentiator. So I don't think there is any requirement to modify that and at this point in time. Also, the objective of the SFB is to further financial inclusion among the underserved and the unserved through using high-tech and low-cost operations. And meeting the priority sector norms, etc., is a key part of this entire process. So I think the norms continue to be at that level for the priority, for the SFBs.
Okay, so that's the RBI governor and the press conference which is taking place. Well, for the markets, it's completely unperturbed. No significant movement which has come in. We have the Bank Nifty, which is up around 160 odd points, and the mid-cap index, which is managing to continue outperforming, so up around 225 odd points currently for the mid-cap index. Maybe the 10-year should come up for you. It's been quite stable at around 7.10 odd levels pre and post policy, so maybe the 10-year should come up for you as well. So just about 7.13, so it's hardened a tad bit. Well, to talk more about the RBI governor, he did allude to the fact that cuts and hikes in the past have preceded the US actions, and policy is primarily determined by domestic circumstances, and any rate action is going to be determined by the inflation trajectory. So that was the larger picture coming in from the RBI governor. Neeraj Gambhir, who is the Group Executive and Head Treasury at Axis Bank, Ashish Vaidya, MD and Head of Treasury at DBS Bank, and Soumyakanti Ghosh, the Group Chief Economic Advisor at SBI, is joining. They're all joining in to discuss the policy with us. Well, Soumya, I'm going to start with you. What was your overall takeaway from the policy? The RBI governor himself said that it was largely in line with what the market expected.
Yeah, thank you, Ekta. No, I think the monetary policy was on expected lines. The growth projections at 7% for next year. As you know, that the last year we started with a 6.5% projection, but ending the year possibly with an 8% growth rate. So possibly the growth numbers for 7% for next year could be a little bit on the lower side. If you compare the forecast which has been given in the MPI report in terms of the professional forecasters, also in terms of the savings and investment numbers. So that is one thing. The second important point is that I think the RBI communication as usual is very nuanced, pragmatic, and is guiding the markets in terms of the overall expectations. And I think one of the possible policy, I'll not call it a surprise, but I think one of the policy measures which is also a pleasant surprise to the market, it could be a surprise to the market, is the review of the LCR norm, because as you know, the governor has been pointing out that the liquidity management is going to be the most important and challenging task, continue to remain in the next year also. And in this context, the review of the LCR norms, other things could actually please the market in terms of being more attuned to what the RBI is supposed to do. So overall, it's a good policy. The numbers are in line with the market expectations, no surprises, and it was expected as usual.
Okay, all right. Well, Neeraj, there's been a tad bit of an up move which has taken place in the 10-year. Nothing really to write home about. It's moved, say, from around 7.10 to 7.13. What is the bond market making of this policy?
Well, I think in my view, even though there's nothing surprising in this policy, pretty much along the expected lines, but in some senses, the timing of any possible rate cut becomes quite uncertain, right? The uncertainty starts with when Fed is going to do it. The market's broad assumption was that RBI will be moving, if at all, after Fed has moved. Now, the Fed's timing is uncertain, and hence, given the commentary around the growth and given the commentary around inflation, even Reserve Bank's timing looks quite uncertain. So I think there is some bit of that realization which is dawning in, which is what is leading to the uptick in the yields, and also the fact that we are in April now. The government borrowing program has started in the earnest. Today is the first auction, so I think market is again creating some kind of a space for new supply to hit in this quarter.
Okay. Well, Ashish, what in your sense is the bond market factoring in when it comes to the first rate cut from the RBI? And to be, to be correct, the RBI did mention rate action based on what we are expecting from inflation. But in any case, the possibility of a rate cut.
See, for now, given where the markets are trading, I think the bond markets are probably looking at cuts starting beyond October or beyond. I think, but it's very important to understand the drivers which he has mentioned, which is basically the last mile of the inflation is the most difficult one. And also the fact that the global commodity prices have been on the upswing in the last few weeks and months. The risk to food inflation. So like Neeraj mentioned, I think the uncertainty has actually increased while the markets globally as well as in India were positioning for a rate cut sometime during mid or third quarter of the calendar 2024. That's sort of becoming uncertain, and that's the exact reason why the markets have probably given up some a two odd basis point on 10-year. But broadly, I think it's a range. And I think we are just still at status quo. We will have to look at how the macro numbers pan out and then take the cues. So there is no certainty in the markets. But clearly, from a macroeconomic sense, we are at the top end of the interest rate cycle. So the market will always be looking out for cues as to when exactly the RBI starts to cut rates.
Okay, all right, absolutely. Well, Soumya, coming to you on that, the big surprise was there was no change in terms of the GDP forecast for FY25, which stays at 7%. Was there an expectation from your side that there would be a change, and how would you read this status quo?
No, I think the governor has already said in one of the press conferences that growth rate this year could be close to 8%. You just have to wait for 2 months. I think on May 31st, you will know the number for last year. So from that perspective, I think it was best to make any revisions to the forecast in the MPR report, because I think we are too close to that date. So obviously the final figures will be out in 2 months. So there is no point in revising the numbers again. What I mentioned at the beginning of the show, I think that possibly the projections for FY25 could see some sort of a change as the year progresses, given the fact that numbers and everything all continues to be quite strong at this point of time. Maybe just that the Reserve Bank wants to get the elections over and then the new dispensation takes power and then look into the numbers in a more holistic manner.
Okay, all right, fair enough. That point is taken. Pranjal Bhandari joins in she's the Group Economic Advisor, she's the Chief India Economist at HSBC, who joins in to discuss the policy with us as well. Pranjal, hi, welcome to the show. Inline policy, what were your key takeaways?
Yeah, thank you for having me. I think while it looks very hawkish on the outset, I think actually the RBI was able to strike a very fine balance. It sounded hawkish today, which was needed because vegetable prices, protein prices are up. Oil prices have risen 10% in the last quarter. Real rates don't seem too regressive because credit growth is strong. A lot of liquidity easing has already happened. So there was no reason to sound dovish today. But at the same time, in the MPR that was released alongside, it gave a very clear indication that 1 year hence in FY26, it actually expects inflation to fall to 4%. It expects growth to stabilize at 7%. And then, because real rates are always with 1 year, hence inflation, it actually signaled that at some point it will find some space to cut rates. So I think that's why it was a fine balance. Hawkish today because there are a lot of pressures out there, geopolitics and so on and so forth. But yet, once the Fed starts cutting, then at some point the RBI will also find that space. And I think that was clear in the NPR. So I would say I would look beneath the surface and call it a little more balanced rather than outright hawkish.
Okay, a little more balanced than outright hawkish. But Pranjal, what is your sense in terms of growth and the fact that the GDP forecast was stagnant at 7% for FY25?
Well, look, it's not that I was expecting them to increase it from where it is already. We know that the last quarter GDP data we got, there was this big difference between GDP and GVA. And we know a few reasons that, there were a lot of changes in the subsidy bill for fertilizers. But we really have to see where all of this goes. Because remember, GDP will now have to grapple with a higher base, whereas we are not sure where GVA will be. So I think with so many uncertainties, many of them statistical, I think it was a good idea for the RBI to not really change any numbers at this point of time. Having said that, I must also say that growth remains strong. In fact, I would argue stronger than where it was at the end of 2023. End of 2023, towards the end, we had seen all the PMIs had started softening. But now, Jan, Feb, March, all of the PMIs have started rising quite a lot. And we're also seeing signs, which I think even the RBI governor spoke today, that rural demand is rising a little bit. If you look at, the Jan Dhan, the deposit cash balances or remittances from urban to rural India, there's some sort of increase in consumption in rural and informal sector. But I would say we have to wait for the statistical issues to get ironed out before the RBI changes any of its growth forecasts.
Okay, all right. That point is taken. Well, Neeraj, coming to you, what is your sense in terms of what the market is expecting when it comes to inflation? Because we have a couple of variables, vegetable prices, Brent crude, which is now at over $90 per barrel. And then we have the monsoon as well to wait for, not to mention the heat wave. But your sense in terms of what the inflation trajectory could be?
So I think, inflation is a story of two halves. The first half is the fact that core inflation actually has been on a sustained, reduction path for almost 9 months now. And we've seen over these 9 months, the core inflation come down by roughly 250 basis points. And it's much below 4%. So I think from that perspective, there is a very strong comfort that you can draw around inflation. The issue, as the governor has also been pointing out, is in the food and some of the other volatile components. It's very hard to forecast as to how these components will play out. There are many supply side issues that can hit these components. But the only comment that I would like to make is that if we see sustained disinflation in any of these components over 2 or 3 months period, then the amount of space that is available for the monetary policy to ease up can open pretty quickly, because the core inflation continues to be in a very, very good spot. So I think the forecast on inflation, as far as our economics team is concerned, is very close to what Reserve Bank has forecasted, around 4.5%. But I think the downward revision on that can happen in a very short period of time if the volatile components of inflation, play or behave well at any point in time.
Okay, all right. Well, Ashish, one of the key points was that, which the RBI governor did mention during the policy conference, was that the policy will be primarily determined by domestic circumstances and not really what the Fed is going to do. And, in past instances, we've in fact preceded the Fed. Do you now think that we could probably not follow what the Fed is doing and maybe completely not determine, it won't be determined by, say, the first Fed rate cut, which is estimated in June?
So the way I look at from what the governor has stated is obviously the primary drivers are the domestic issues and the way the domestic economy is shaping up. But having said that, I think we are a subset of the global economy, and there are moving parts in the world. So we will obviously look at those as well. Maybe those are not the driving factors, but clearly the local inflation, the local growth dynamics will take the center stage. And I think that's really what he is hinting. Let me give you another nuanced answer to this. So the bond market participants and equity market participants will always be talking about rate cuts because it suits them, right? But the real economy actually needs to get affected, and growth needs to actually suffer. And in terms of real rates being significantly or basically denting the growth. Till that it doesn't happen, I think RBI is looking more at the economy in a holistic manner. So it's not just about bond market or liquidity market participants, it's actually about what the economy is doing. And I think economy is doing absolutely fine. So there is no hurry for a rate cut. And that's what, to my mind, RBI is hinting at.
Okay. Well, Soumya, what is your sense in terms of hitting that 4.5% mark when it comes to inflation?
No, I think in terms of inflation also we are pretty at this point of time for an 4.5% target. In fact, these inflation projections with RBI has built up over time could see it could even be lower than that one. And in the first 6 months, you will actually see the inflation coming up because of several other impacts. And July, August could be the months where the inflation could be closer to lower than 4%. So from that point of view, I think the inflation numbers are well anchored, and the markets are also well anchored in terms of a lower inflation trajectory throughout the year. So 4.5% to me looks a very reasonable target at this point of time.
Well, what is your sense, Pranjal, what is the house estimate for Brent crude, and what can we expect on, say, the commodity front, which could probably weigh on inflation?
Yeah, it's been very obviously volatile, but we do expect it to be closer to about $80 a barrel, going forward. So hopefully a little softer than where it is right now. Of the impact of all of this on monetary policy. Look, my sense is that one of the reasons why core inflation prices fell so much, and the PMI shows it very nicely. I think through the last year, PMI manufacturing shows that producers were able to cut output prices while input prices fell so much. So I think commodity prices falling was a big part of core inflation falling. And now if commodity prices are going to stop falling, or perhaps be slightly higher than what was anticipated below, I think this is something that we can't completely dismiss. I think it's something we'll have to bake in and follow very closely. But having said that, on your other question on Fed and the RBI, a few months ago, we were thinking that as soon as the Fed cuts, the RBI will cut too, in line with many other EMs. But it now seems that RBI is not in any hurry to cut. It follows its own domestic path, which you also mentioned, of closer to 4% sustainably before it starts cutting. So now my sense is that even if the Fed goes ahead and cuts in June, which is our house forecast, we may not see the RBI cut as early as June. It could be earliest August, or a little later. And I think that time is a little opportune for India, because by then the election uncertainty will be behind us. By then we'll have a good sense of how the Kharif plot is looking. And we'll also have a good sense of how the bond inflows, a lot of which is likely to come in June, how that impacted liquidity and need for monetary policy easing. So I think August or beyond, even a bit later than when Fed cuts.
Okay, interesting. So that point is taken that maybe the RBI is probably not going to act as soon as the Fed acts, and that was the expectation earlier. So maybe they could probably start cutting August onwards. And yes, a lot of the triggers would be out of the way by then. But Mr. Neeraj Gambhir, as well as Ashish Vaidya, Soumya, as well as Pranjal, thank you very much for joining me this afternoon and taking us through the RBI policy. It is the first policy of FY25. It is a policy where there has been a status quo in terms of rates for the 7th consecutive meeting. And in fact, rates have been status quo now since April of 2023. Well, we need to take a short break, but a lot more on the markets, a lot more on the RBI policy once we're back. Stay tuned.